Good afternoon, everyone, and welcome to our second quarter 2021 quarterly update and financial planning tips webcast. On today's call, you're going to be hearing from Prestige Wealth Management Group CEO Roy Williams, Wealth Advisor John D'Angelo, and Senior Portfolio Manager Paul Esposito. Just as a reminder to everyone, we have a chat box that is listed on the Zoom webcast. You're able to submit some chat questions. If we don't have time to answer them during our webcast today, we will follow up with you individually. If you have any questions after the webcast and you want to follow up, please email us at pwm@prestigewmg.com. And with that, I will pass it over to Roy.
All right. So we're going to talk today about the global reopening process. And really, to start the discussion, we're going to talk about COVID, because that really leads the discussion regarding the opening. The vaccinated countries have an advantage in opening, and we're going to discuss that. Paul, you and I were talking about the COVID cases increasing and hospitalizations increasing today and the impact on the economy.
Right. So I think, obviously this whole change in cycle, right, the close of the last cycle, start of this cycle has all been surrounded, by getting in front of the curve.
Cycle, you mean economic cycle?
Economic cycle has hinged upon getting ahead of the curve with COVID. It looks like that, we did a very good job, at least most of the developed countries, the U.S. in particular, did a great job in rolling out vaccines. We just, as of yesterday, reached that 70% mark of vaccinated individuals. And then if you factor in individuals that have maybe gotten the virus, you could say, for all intents and purposes, we're close to herd immunity. The other European nations have done a good job, and it's evident if you look at just the economic recovery of all global markets. The key driver behind that is their success rate in rolling out vaccines and getting ahead of the curve. Surprisingly, there have been some developed countries like Japan that have not been as successful, and two noteworthy countries, Brazil and India, in the emerging world, haven't done such a great job in getting in front of the curve there.
Yeah, I think, John, you and I were talking about India and some of the poorer countries not having access to vaccines,
right,
as being an issue.
Right. Today, the WHO actually, one of the things that they noted was that they didn't want to see any vaccine boosters until low-income countries got their vaccination rates up north of 10%.
Yeah, I think that's important as we go along. And, to note, even vaccinated people can get ill. My neighbor recently got the Delta virus, and the good news is he had no more than a cold. But still, he had the ability to spread it without realizing that it was the Delta virus. And now we have a new virus coming from Colombia that has a number behind it, doesn't even have a name yet.
Right. I think that poses one of the risks of the economy continuing its trend of reopening. Especially when we look at cases. Toward the end of the quarter, it looked like, everything had cratered, right? We, had the lowest amount of confirmed cases since March, lowest number of fatalities. Just within the last month and a half, we've started to see case counts go up, mostly due to the Delta variant. The time will tell, because fatalities, at least at this point, have not moved up in lockstep. So that's at least one silver lining to, I guess, the whole process of vaccination.
Part of that is the fact that the medical community also is starting to learn how to treat COVID better than they did when it first came out, too.
Yeah, I have another friend of mine who, 45, runs mini marathons and in great physical shape, who got COVID and who was about to be put on a ventilator, went to a major hospital, and he got the antibody treatment. And he was released the next day and recovered very quickly. So to your point, John, we do have treatments now versus in the beginning we didn't have treatments. Who knows how long this will be with us, and we'll continue to monitor how it impacts the economy. One thing I'll say, just be safe, be careful, and if you get sick, get tested and see your local medical practitioner. So this is interesting when we speak about the unemployment rate. And when I say it's interesting, I don't care. I was in the Milburn office last week, walking down Main Street just to go for an afternoon walk. It's amazing how many help wanted signs there are. I would say probably 70% of the businesses that were open had help wanted signs out there. A friend of mine owns a couple fast food chains, and he tells me he offers $15, $16 an hour, and he can't get employees. So this has really been a challenge with the unemployment rate and extension of unemployment benefits.
Yeah, sure. It's been, I would say, a very interesting trend, to say the least, because,
Well, even the ADP report today was very light.
300 some odd thousand, and is expected over 600,000.
Right. But I think, if you look at this cycle and what had happened, obviously the additional unemployment benefits, has been probably one of the bigger drivers behind the stubbornly high unemployment.
Right. I mean, one of the things we talked about just yesterday was, we may not really see these numbers normalize until November.
Very, very possibly. So there's been, I guess, two conflicting arguments. One is that, the number of unemployed is really indicative of more structural unemployment. Individuals don't possess the job skills necessary that employers are looking for. But the truth in this chart, and the chart that we'll show very shortly, I think portends to the other argument, which is the additional benefits. People are now essentially being incentivized to stay at home and receive higher pay as a result of the additional supplemental benefits that they're receiving.
And what you mean by that, Paul, with the supplemental benefit, people are earning over $21 an hour staying at home. So there's no motivation except the $15, $16 an hour job.
Right. And this summer versus last summer, the other mini phenomenon I'm also keeping track of is that parents, there might be one spouse that may decide to stay at home this summer and take benefits because with factoring in childcare costs, it's really not worthwhile for them to go seek work and then also pay. So again, a lot of that goes back to, the additional benefit.
And I think the next chart, John, really shows the opportunities for jobs are really out there.
Yeah, I mean, I think that the JOLTS report is indicative of job openings. Those job openings match the number of unemployed individuals. And a lot of the job openings are in, those spaces where, to Paul's point, a moment ago, it may not be worth taking the job yet with the additional benefits. So, the waitress, the guy working we just went and got a cup of coffee earlier at Dunkin' Donuts. The whole interior of the store was closed because they had help wanted. So, counter workers, our counter workers gonna go back to work until those benefits are cleared. So we should start to see some of that work its way out.
And I mean, this paradigm that we're seeing right now is really constructive for the consumer. And going back to the last chart, if you look at wages are going up with unemployment staying at higher levels and with job openings at record high levels. Normally, you don't see job openings at these levels until 3-4 years after a downturn. Go back to the last business cycle, 2008 to 2009. Job openings didn't get back to their 2005, 2006 peak until 2014. So again, the manufacturing of shutting down the economy and reopening is probably the key driver. But you then add the additional stimulus and the unemployment benefits. It just exacerbates this number. Yeah. Somewhat good for the consumer, could be problematic for businesses because wage costs are going to be going up. That's another topic we're going to discuss at length is inflation in a little bit, but that could certainly put pressure on margins. So that's another area of risk that we're looking out for, in addition to variant reemergences.
Yep. So, next we're going to talk about home sales and prices, this is, to begin this area, I'm gonna give you a 5-star tip. This is me personally. I would never buy a home without an inspection. And I don't recommend clients buy a home without an inspection. And we've seen, John, because it's been such a boom in the housing market, that people are forgoing their inspections to get the house and buying 30, 40-year-old homes without inspections, which could be very, very costly.
With people running from cities to the suburbs with COVID, you're seeing people bidding on houses. The houses are up on the market for maybe an hour or 2 hours before they have multiple bids. You know, so yeah, to your point, I think we've certainly peaked, you know, as far as the housing boom is concerned.
Yeah, and I think even the cities are, from speaking to clients in Chicago, and I have a friend of mine now driving cross country to bring his son to New York City for school. His first comment to me was the cost of apartments has just skyrocketed in the past 3 months. And he wasn't sure where he was going to school. It would have been great if he could have rented 3 months ago, but he wasn't sure where he was going to go to school. So now we're seeing cities actually pricing come back.
You are, but I think by and large, if you look at just the overall trend, you know, Q1 into Q2, a ton of buyers fatigue. You know, as evidenced by the, you know, existing home sales. You've had home prices go up due to, you know, short supply, short demand, an increase in demand. Obviously, commodities costs for new homes help bring up the value of existing homes, so that added to pricing pressure on the upside. And at the same time, you know, that's going to cause prices to move up in lockstep. And I think, you know, toward the end of the quarter, we started to see that fatigue set in. Interestingly enough, it really didn't have, you know, the lowering of interest rates now. Will that ensue? At the end of the quarter, we had a 10-year Treasury at about 1.4. Today, we're at 1.12, 1.13. So we might be taking a breather here, but, you know, another, I would say, catalyst for, you know, the horizon going out into September into October is going to be the eviction moratorium. Mm-hmm. We have 12 million at-risk tenants and homeowners, 7 million homeowners and 5 million renters that are over 60 days past due. So that could complicate things. We could start to see some pricing pressure as a result. So again, another risk that I think we need to be cautious for.
Yeah, and I think don't be surprised if you see foreclosures go up very, very significantly, because there are none now. So don't be surprised if you see a large number in the next 2 quarters. But the good news is, you know, as we spoke as a team, we feel the market most likely can absorb it because there's a shortage of housing right now. So when people have to sell their homes because they're being foreclosed, they'll have liquidity and be able to sell them.
Right.
Paul, you love this chart, Paul. And it's a very busy chart, but why don't you simplify it for everyone?
We'll try to simplify this. So if we just focus on the 2 columns for 2021 all the way over to the right, it breaks it down geographically. This is looking at manufacturing and services activity, basically, you know, economic growth throughout the world. So it looks at things globally, then it breaks it down between manufacturing and service, developed, emerging markets, and then it breaks down all the developed and emerging markets. The big takeaway is the globe is growing. Both manufacturing and service-based economies, by and large, are growing. The areas that have, you know, had a little bit more anemic growth, it just happened to correlate with their rollout for vaccines. If you look at the emerging market world in particular, they're kind of teetering on growth to suboptimal growth. In particular, if you look at India's print, they're actually in contraction. Same goes for, I mean, Japan being, you know, one of the outliers in the developed world. And China's, you know, growth, I think, is really not necessarily, you know, hinged upon their management of the virus, but it's more geopolitical. The CCP's imposition on the tech sector, I think, has that and some debt issue problems that the rest of the world is starting to recognize is really putting pressure on those markets. But the other takeaway here is you can notice that, in 2021, the countries that managed to start reopening their economies earlier were the ones that started to turn green faster. So it'll be interesting to see some of the other countries that need to play catch up, if they in fact are able to come closer to the rest of the group and cluster toward a trajectory of growth for both services and manufacturing.
So what this chart really shows is great news in terms of there's a pent-up demand from the consumer. John, you and I were talking about this, be it vacations, be it appliances, TVs, cars.
Yeah, especially travel. I think there's been a big uptick in travel, domestic travel especially, this summer.
The next thing we're going to talk about is inflation. This is probably the biggest question we have from clients is really what's going to happen from an inflationary standpoint. And there are different ways to look at this. And Paul, why don't you discuss inflation a little bit now?
Okay. So, undoubtedly, if we look around, just within the last year, we've seen prices go up in aggregate. You go to the grocery store, you've seen meat prices go up. We've seen shrinkflation, right? The same unit of orange juice is now lesser fluid ounces, but I'm paying the same price. We go to the pump, gasoline prices are 30% higher. Materials costs, right? Talking about housing, new construction, we've seen, the cost of wood go up exponentially, from the prior year. Same thing with concrete, same thing with steel. And if we look at this chart just highlights overall CPI and then it breaks it down. But if we look at inflation as measured by that headline number, as of the end of June, we're looking at, and this is on a year-over-year basis, inflation rose at a pace of 5.3%. Now, that seems very staggering, especially considering what the Federal Reserve is targeting for an inflation rate of about 2.5%. And it's been raising some alarms. Has this been a sea change that is going to create, a higher run rate of inflation for the next, 5+ years? Is this going to be the new normal? And I think, there's a few dynamics at play that, do discuss, how are able to explain the reason for this sharp rise in the rate of inflation. First off, anytime we've come out of a recessionary downturn, you go back into the financial crisis or even prior recessionary cycles, because there's been a contraction in economic activity, naturally when economic activity accelerates, you're going to see some inflationary pressures. Now, this go around, we had supply chain disruptions. And, whether it be in lumber mills, whether it be in the chips, the semiconductors.
Yeah, Canada was stopping anything from crossing the border either way.
Right. So, the Fed's take on this is that inflation at this point does seem to be more transitory, right? More short-term-esque than to be more permanent. And I think as a firm at this juncture, we do share that view. Especially when you look at just some of the dynamics that are going on in the commodities complex, and we'll talk about that in a minute. And then just the overall trend in interest rates. Rates have come down. The 10-year at the close of the quarter, as I said earlier, was about 1.45. We're now at 1.12. The bond market tends to anticipate the run rate of inflation well before the market can. So that kind of highlights our conviction that we're in a more transitory environment.
And what transitory means for most people out there is that it's a temporary inflation spike. I think, John, it was 2013 or 11, we had a similar kind of spike. So it's going to be interesting to see as we go through this, But as we were speaking earlier, John, oil today was below $68, down $2.
Down again in but oil, of course, has had a massive recovery from when everybody was quarantined and
Negative oil prices.
Right, nobody was moving at all. I think some of the pricing power for oil has moved offshore to more pricing power for OPEC Plus versus U.S. I think they've taken probably some of our production. So oil prices might be a little bit higher for longer versus some of the other commodities, but I think all in all, the signs of the inflation numbers being transitory, I think is the right argument, especially based on interest rates. I mean, interest rates where they are, you would expect them to be much higher if inflation was going to be long-lasting.
Talk about lumber.
Well, John, look at, the artificial supply-demand dynamic that happened with the lumber market. So we get most of our lumber from Canada, and those lumber mills were shuttered during, the height of the pandemic. And when they shuttered those mills, I mean, these places are out in the middle of nowhere. So all of the workers there are basically sent home. And then, of course, you have this trend of deurbanization, individuals wanting to, make additions and increase their dwelling space. So that caused demand for lumber to start to go up to a more normal level, but supply was essentially shuttered. So we saw all the way into early May this year, lumber prices skyrocketed to almost $1,700 per 1,000 board feet. So they were up, well over 60% at the peak this year, and then from May all the way until just recent, they've lost over 63%. We're actually now negative on lumber prices for the year. We actually touched on July 15th, we touched the pre-pandemic level for lumber prices of about $450 per 1,000 board feet, and that is all hinged upon how quickly these lumber mills were able to get their production capacity up and running. We call it at the office the wheel of shortages. Every day, there seems to be some sort of supply chain disruption. A couple weeks ago, it was semis. A few weeks prior to that, it was, certain cuts of meat. I just think that as we start to get back to a path of normalcy, we'll start to see more normal pricing. Now, the question is, will there be at least some lasting effects of inflation? Undoubtedly, with the amount of stimulus that the Fed has induced on this market, it's tough to say. Producers always love to keep prices high.
I think, too, we have to look at what this infrastructure bill looks like, and is there a follow-up bill to that could certainly allow prices to remain higher for somewhat longer while the additional stimulus gets through the system. Because we're talking about anywhere, from $1 trillion to $4 trillion, depending upon what they pass.
And what's crazy about the stimulus is if you look at the amount of cash or trillions of dollars in the banks, it's gone up by almost the dollar amount of the stimulus. Right. So it's there's a lot of pent-up dry powder, as they would say, in the industry. So the next, probably a second biggest question we get from clients is the market overvalued, Paul? And we were discussing this as a team yesterday, and wanted to give our perspective.
Well, I mean, our perspective is, I think this, we need to look at things from 2 points. One, is standalone is the U.S. market, and we're going to use the S&P 500 here. Is it overvalued unto itself? And two, there's been a lot of talk about the U.S.'s valuation in respect to developed markets and emerging markets, because we tend to trade at a higher price earnings multiple. From a historical basis, based upon the trailing 20-year average, we do look moderately expensive at this level. But the big argument behind valuation right now has to do with a couple of things. One, it has to do with the rate of interest. So if you go back to 2000, March 24 of 2000, the forward price earnings multiple was trading at over 25 times, yet interest rates were very high. So normally higher stock valuations can be justified by a lower interest rate because that's the discounting mechanism that's used for ascertaining valuation for stocks. The other reason, very simply put, is where else are you going to put your money in order to get a rate of return better than what the bond market is, or better what, should I say, in this case, the Treasury bond market is providing. And that is going to compel investors towards stocks, and it's going to keep valuations higher.
Well, I think also, John, you and I were talking about, you have a significant acceleration in earnings.
Yeah, absolutely. Have both an acceleration in earnings and also persistently accelerating in stock buybacks. There's a lot of liquidity, and it's buying stock.
Right. So, Roy, we just looked at the numbers for at least where Q2 earnings are coming in right now, because we're in the middle of earnings season. So this year, on a year-over-year basis, just Q2 earnings are expected to rise by 82%. Now, for the entire year, compared to 2020, we're expected to go have an increase of almost 47%. So a drastic earnings recovery.
Yeah. And the earnings surprises have been positive overall.
But more so in the first quarter. We have seen, a mixed bag here so far in the second quarter. But the revenue and the earnings trend are supportive because we really haven't seen our multiple expand to a level of 25 or 26, meaning price is going up, but earnings are staying stagnant, and with that, revenues are staying stagnant. So we are showing signs that we're growing in earnings. Now, toward the end of the year, will that taper off naturally as we become more normalized and into 2022? Instead of having these massive double-digit gains in earnings, it's probably going to be somewhere around the low to mid-single digits as things normalize.
But I think you may have an acceleration in stock buybacks as companies that, like a Disney, that was significantly impacted with the parks, and as their revenue normalizes, they'll start buying back stock, and stocks like that,
right,
that were impacted by the pandemic more than others.
Right. So, we talk about the U.S. and its relative value into itself, and looking at that in reference to the rest of the world. We as a firm have taken a very U.S.-centric stance on managing our stock portfolios within the last 2 years. There have been a lot of pundits out there talking about how cheap emerging markets are and developed markets are. My retort to that is they're cheap, and they're cheap for a reason. It's very myopic to just be using a PE multiple in isolation as a reference of value to any capital market, whether it's the S&P or whether it's the MSCI EAFE or the Emerging Markets Index. But we need to look at other data to confirm why, in fact, the S&P is trading at a 20 multiple where international developed markets are trading closer to a 15 or 16, which would be perceived as cheaper, all things equal. Well, what this chart shows, and I apologize for the font size, but the silver lining at the top of the first line at the top of the chart is the S&P 500. The green line is the MSCI EAFE index, which is an international developed market, and that brownish gold line is emerging markets. And what this is the percentage gain in revenue over the last 3 years. So going all the way back to August of 2018, the only market that has been able to deliver on an earnings increase has been the U.S. economy. We're up almost 13.5% in revenue over that time period. And that also factors in us shuttering our economy in March of last year. You look at where the European and developed markets are with the green line, they're slightly negative over a 3-year time frame, and they haven't even recovered their pre-pandemic level. The same goes with emerging markets. Now, we could talk at length for the macroeconomic reasons behind that, but this is one of those metrics that just outlines why the S&P, why the U.S. markets are trading at a premium, and really we shouldn't be perceiving them as trading at a premium. They're actually
another thing to note too is we're getting some global exposure through large cap U.S. multinational corporations. We're getting that exposure without the geopolitical risk that comes, from some of these countries such as China.
Yeah, our large company stocks, 40% of their revenue as a whole comes from overseas.
Right.
From Europe and Asia and the other parts of the world. So.
Correct, and the proof has been in the pudding. If you look at performance deltas, the international developed markets are behind 8-9%. Emerging markets are behind by over 12%.
Right.
Emerging markets, as of just recent, are just printed positive. They actually went negative for the year last week. So a lot of those pressures and the lack of recovery in earnings and revenue for that matter, I think are indicative of some more problematic times.
Now with China, you have problematic, it's the government.
Right.
So, we don't have time today to get into the discussion, but to close out, I just want to, Michael is going to take over and discuss Michael Williams' financial planning tips, but I just want to, again, for my part, ask everybody be safe, be well, and, hopefully soon we're through this all and we can start seeing everybody again. And with that, I'll turn it over to Mike.
Thank you. So we're going to wrap up with a financial planning tip that kind of goes in line with some of the things we discussed today, especially around, the future state of the economy and maybe some uncertainty around that and uncertainty in the future state of the markets. One of the things that tends to happen is investors tend to, in light of uncertainty, will either, have higher levels of cash, or you could run into a position where maybe you have inherited a bunch of money, or maybe you sold a home and you've come into some cash, and you're a little nervous about kind of putting that money to work given all the uncertainty. So one of the tools we're going to talk about today is called dollar cost averaging. And dollar cost averaging is, by definition, it's a systematic investment of a fixed dollar amount at regular intervals. So if you think about it, maybe if you're just starting out, maybe you're investing, a few $100s a month, or even if you have a larger, cash base, you're investing a few $1,000s a month. The ultimate goal of dollar cost averaging is really to kind of smooth out your investment returns given the volatility. So if the markets are dipping, you're investing at lower and lower levels of the market in order to kind of capture some of that downside. So once again, let's talk about who is it appropriate for, and maybe even who it isn't appropriate for. If a investor comes into a large amount of cash and they are uncertain about the markets and they are uncertain about the future, if you're in a position where you're hoarding that cash, and we always want to give the caveat is we always like to have a certain amount of cash reserves. That is appropriate to always keep in cash. But above that dollar amount, given the amount of money you're making in your savings account, interest rates are at 0.01, you're probably better off investing some of that into the markets, but you might be a little nervous about how to do that. So dollar cost averaging gives you kind of a tool to use to get over that mental hurdle of investing in the markets. So when we're talking about the strategy, who it's probably not appropriate for, if you're younger, or maybe your son is just investing in the market and he has a small dollar amount, it might just behoove him just to put it all into market, all into the market, as many of the studies over the long term have found that performance of either dollar cost averaging versus putting it all in markets at once are kind of a wash. And really, the value of this is comparing dollar cost averaging versus not investing at all, which there is a big difference. Obviously, when you're trying to time the markets, it's extremely difficult, and especially in times of high uncertainty, it's nearly impossible. So you see times where, around the elections, people will just sit on large amounts of cash, and by the time they feel comfortable investing, it's usually they're missing out on a large amount of returns, versus if they're using dollar cost averaging, they're not really, using a lot of the mental capacity to put that money to work. It's kind of happening automatically. And a lot of people, you're already dollar cost averaging, you might not even know it. So one of the major advantages of a 401k is not the fact that it's on a pre-tax basis and all the tax advantages. It's the fact that when you set it up, you're kind of not thinking about putting that money to work. It's getting taken out of your paycheck, and it's going directly into your retirement savings, directly into the 401k. So using dollar cost averaging is kind of that same concept, and it kind of puts that money to work, and it gets you invested without having to have that mental hurdle. So just a visualization of it. We're having, kind of three scenarios we laid out, whether a rising market, a declining market, and a fluctuating market. The first one in the rising market points out kind of the risk of dollar cost averaging. Over time, obviously, the markets have tended to move higher. So if you are dollar cost averaging into a market that is kind of screaming higher, you're investing at higher and higher levels, so your overall returns might not be as great as they could be. But the polar opposite of that is in a declining market, you're going to be investing at lower and lower levels, and your returns will benefit from that. And again, in a fluctuating market, you're going to end up somewhere in between. But again, the real value of dollar cost averaging is not exactly trying to time the market. That is very hard, borderline impossible. It's really, using it as a tool to make sure you're continually investing and not just kind of sitting on the sidelines with a large amount of cash and having paralysis by analysis. So hope you guys get some benefit out of that and something that you guys can use in the future. With that, we're going to thank you guys for joining us. If you have any questions, again, you can reach out to us at pwm@prestigewmg.com or give us a call at 908-782-0001. I'd like to thank everyone for joining us again, and we'll talk to you soon.